One
Great.
other thing I wanted to note here real quick before we get
Hmm.
started fully is when you list stuff like this,
Hmm.
when I first started, I had major problems remembering what if these were in millions, thousands, or billions of dollars. So
Ah,
make sure you remember that, um, and you note it somewhere up here or on your notes on your Word doc or whatever, because that's a major problem I ran into. Because obviously, if you get confused, like going between Apple and Goldcorp, which Apple's almost $1 trillion company and Canopy's a $3.7 billion company, if you mistake this for millions of dollars or tens of millions of dollars or whatever instead of billions, that could
of
lead to a
course.
massive difference in valuation.
Of course. And, interesting, when I started to go through this, I had another column that said millions.
Uh huh.
But as I went through this, all their financial statements, the market cap was typically in billions, but all the financial statements said millions. So I actually took it off, and I thought I'd put a note higher up in the sheet. Can you scroll up in the sheet? I could have sworn. There
Oh,
it
there
is.
we go. There it is. Perfect. Yeah, I didn't even see that. I automatically, when I opened it, it
Oh,
automatically
it was right
crossed
there.
out.
Okay. The same thing. I tried to be very careful to make sure all the figures I guess, were in millions, and they all had um, the same base, or the same multiplier, I should say.
Yeah, and I'll show you right now actually an example. And because I evaluate a lot of smaller companies,
Mm-hmm.
I run into this a lot when I am evaluating different sizes of companies. Right
Uh,
here,
yep.
right now,
Thousands, sure.
they're in thousands automatically on my Morningstar because I evaluate more smaller companies, and that's automatically what I turn it to.
Ah, okay. I didn't know you could even change that,
Yeah,
actually.
it's this rounding number right here, up or down. See, now it says millions.
Yeah, I had a column that said denominations, and then as I'm on my sixth company, I just noticed they were pretty much all in millions. But you make a good point. If we're focusing and looking at a lot of small caps, it's probably going to be more thousands, I'm guessing.
Oh yeah, yeah, and that's
Okay.
something. That's something. Yeah, we'll get into it more in depth later, but it's something I noticed that I wanted to let you know about because it's something I had a major problem with when I first started. I would get confused on what the numbers were, and I have to take time and go back and look. Are these millions or thousands or billions or whatever the number was?
That's a good point. One thing I tried to look for is column G is Constellation Brands they have different fiscal years.
Yes.
And so I wanted to make sure I kept that number the same. I noticed on the balance sheet over to the far right, you had the latest quarter, but I did notice on the income sheet there was a column called TTM,
Yes,
I
trailing
think.
12 month.
Okay, so I had to make sure that I wasn't going to the right. I really was trying to cognizant to make sure I was using the correct numbers from the correct column.
Yes, no, that's another great point. I'm glad you brought that up. We talked about it briefly the other day. Every time I go into a financial statement on Morningstar, I automatically click quarterly because I want to see the most recent numbers. For example, if you went to, let's show you right here, if you went just annual,
Mm-hmm.
you wouldn't see any numbers from except for from was that February of 2017. Obviously, we're all at the end now or coming near the end of 2017 now. So you're missing 6 to 8 months worth of data here. So make sure you always are cognizant of what you're looking at here as well. Make sure, because this will save as well. If you always look at quarterly data, it
Mm-hmm.
will always automatically come up as quarterly data on Morningstar as well. And this trailing 12-month period, that's just the last 12 months in total. So going from 2017, 08, 2017 to 08, 2016. That's these numbers added up.
Oh, okay, understood. And what value is that? I guess do you use those for any of your metrics when you analyze it?
I use the trailing 12-month numbers in I think 100% of my metrics
Okay.
because I want, like I said, I want the most recent data available. Actually, now that I think about it, I only use annual numbers. There's one company I've owned stock in for several years. They're a very seasonal business. They do, I think it's something like 85% of their business between October and December every year. So in that case, I will use the annual numbers because their trailing 12-month numbers won't show hardly anything because they're building up for the holiday period.
Understood. So it doesn't relate to their business model really. The trailing 12 months. Is that correct?
For example.
All right. So I'm ready to talk about Constellation when you are.
Awesome. All right. Let's go back to your spreadsheet here and highlight Constellation. One other thing I just noticed before we get started is this USD versus CAD.
Mm-hmm.
We'll get to this more later, but I want to touch on it since you do have a foreign company here.
Okay.
Another major problem I had when I first started is I've always looked at a lot of worldwide companies. I don't, like we talked about last time, I don't just focus on the US like 95% of other people do. But when you do that, you have to be cognizant of what the numbers are in the financials and on Morningstar. For example, I can guarantee if we go to CAD right now, on Morningstar, their share price is listed in US dollars, but their financials on Morningstar are listed in CAD.
Oh, that's a great point.
Well, that's never happened before.
That happened to me yesterday, actually. I had to just close out the page and go back. Okay, so really be cognizant of the denominations.
Yes. And when we do the analysis, again, we'll get to this more later, but when we get to the analysis portion, make sure you do the analysis and all the work in their own denomination.
Okay.
Whatever they listed in, make sure all of their work or all of your work is done in the specific denomination where the country is listed.
Okay.
Because it's easier, I've found, if you do it that way, and then when you get to the end, to convert it to U.S. dollars. Because if you convert it, see exactly, I knew that it would be listed in U.S. dollars here.
Mm-hmm.
But when you go to the financials, it's going to be listed in CAD.
Okay. That's a great point.
Here we go. CAD in millions.
So I'd have to convert that share price to Canadian dollar. And where do you get your conversion factors?
I just use it on Google on the day I'm looking at the analysis. It changes. Okay. I used to, when I first started, I used to kind of get an average, but it changes multiple times every day. So I just do it when I'm doing the analysis.
Well, imagine a lot of the analysis are ratios, so that the number there's no number associated with the ratio.
Yeah, no, but when we get to the actual valuations, you'll
okay.
The U.S. dollar share price. And yeah, like I was saying, when I first started, I tried to convert everything to U.S. dollars to begin with. That led to massive headaches because, of course, then you have to take an immense amount of time to convert every single number into U.S. dollars before you can even start the valuation. So now what I do is I do everything in their own dollars, own denominations, and then I, at the end, just convert the share price into U.S. dollars.
Okay. Good advice. I got that noted.
All right.
Analysis in native currency.
Yes.
So market capitalization.
Yes.
Does that use outstanding shares or does that use a diluted shares? That's outstanding, typically.
I believe it's outstanding. Yes.
Okay, so it's not diluted.
Yeah.
On the market cap.
I don't do anything to convert that because honestly, I don't do market cap very much, anyways.
Okay.
As you'll see, the only time I use market cap is when I'm calculating enterprise value or total enterprise value. So I don't convert that because honestly, I don't use it.
Okay, or total enterprise value. It's which makes sense because the shares aren't in theory out there. They can be converted, but they aren't in theory out there. So they're common outstanding shares. Okay.
Yes. Okay. So this company has was 197 million or 202 million.
Diluted shares.
Okay. I see what they're doing here. They're buying back shares, or they have bought back about 23 million shares in the last quarter. But if you
Mm-hmm.
go back further, they aren't really doing anything. They aren't really getting rid of their shares because they just reissued these shares. You see what I'm saying?
Oh, I see what you're saying. So 205 down to 200, up to 224, up to 225, buy back down to 202.
So companies do this. They they want to say that they're quote buying back shares, but you have to be very cognizant of this because if they're not retiring their shares, they're just reissuing them. Like what it looks like what this company did at least one time. Um, then they're not truly lowering the share count, the diluted share count. Of course, having this much of a difference in share count could affect the valuation by what is that about 20, 15 to 25% off the top of my
Sure.
head. So that
Yeah,
could
10,
affect the company's valuation in
10%.
drastic ways. Companies do this for several reasons. You'll see here, looks like they had a massive increase in earnings in this quarter. So, of course, they bought back shares from here
Uh,
to make it look like they were increasing shareholder value a lot more than they already were. If they would have just left shareholder count or diluted share count the same, they would have increased earnings. But by buying back shares here, they increased earnings by a factor of what, almost four.
oh, yeah.
So
Yeah.
there's a lot, and that's why I don't use earnings. This is a perfect example of what we talked about last time. Is why I don't use earnings or net income because it's so easily manipulatable. This is another way companies can manipulate earnings is increasing or decreasing share count even when they're not getting rid of these shares and retiring their shares.
So how do you know if a company, I guess you can look at the treasury stock over that period too, and the
Yes.
treasury stock in theory should match roughly the differences.
Yes, it should match at least roughly because there's things like options and other
Sure.
things that come into play, but roughly they should match. What I would
Rough-
do in this case is I would go to the annual, and that doesn't even show clear value either because they went up to 25 million at one point here. What I would do here is I would go back over time and look to see what the company's done with their
Okay.
share count. From here, just from the quick view, you can see that they had 182 million basic shares in 2013. They had 190 million diluted shares. And if you look here, it doesn't look like they've increased share count that much. But again, looking at the quarterly numbers, you can tell at one point they were up to 25 million diluted shares, which means since there's such a huge difference between here, the basic shares, and here, they had a lot of, most likely, they had a lot of options that they could have granted to employees, and they got rid of a lot of their options between here and here. Either they expired or they got bought out or something happened between here and here. I would make a note of that to look what happened in the financial reports.
Well, the employees probably exercised the options. I know one employee that started there in 2006, and he exercised his options about 2 years ago. And made a boatload of money.
Yeah, some of them have. I can tell just by looking at the numbers that some of them have been exercised. There was
So,
there was likely some kind of financial engineering here, and not necessarily even in a bad or illegal way, but with the 225 million here and the 195 million here, even if only 2 million shares got added to their share count here on the basic level, but they decreased by 23 million here. So I'm thinking that's why I'm thinking that they either expired or they got bought out because if they if they if a lot of employees exercise their options, this would have gone up more closer towards this number.
Well, what exactly happens when an employee exercises the option? So the stock gets issued to the employee at the exercise price, and then the employee can either sell it on the market. I'm thinking.
Yes.
So
yes.
more stock, when they exercise it, more stock comes into existence
Yes.
on the market.
Most
yes.
of the time, people use that as their bonuses or a form of income, though. Most people don't think about the long term and say, hey, I should hold on to these for 20 years and they'll be worth 10 or 100 times more than they're worth now. Most people have families and car payments and house payments.
Kids in college, sure.
They exercise, kids college, they exercise them and they sell them to pay for expenses.
Understood. Okay, so going back to the balance sheet where it says common stock, what does that mean? Because other balance sheets don't have that listed.
Yeah, honestly, I'm not sure what that means on here because, I'm not sure what it is on here. It's some kind of cost related to the equity.
Because it goes into a positive aspect of the equity, right?
I'm not sure what that is on here. Let's see. But I would make a note to look up what that is in their financial reports. It's what are these in millions?
3 million.
Yeah, 3 million. So this is a $5 billion company. So it's
not
that
really
big of a deal.
Understood.
I still would make a note of it to figure out what that is in the financial reports.
So that's not typical on a balance sheet in your experience, then it sounds like.
No, and like I said, there are a lot of differences between what I typically do and what happens in bigger companies. Bigger companies, like we talked about a little bit the other day too, they have better lawyers, they have more lawyers, they have better accountants and more accountants. So there's a little bit more financial engineering bigger companies generally do. And some of this stuff down here I'm not as familiar with because I don't deal with it on a regular basis when looking at smaller companies, which are generally, unless they're a tech company, a small tech company, are generally more straightforward on the balance sheet.
Okay. Understood. But I guess the takeaway from here is treasury stock has to be used in the EV calculation if it's on there.
Yes, it should be.
Okay. Excellent. So that was one of my questions, and then I think another question on a different company is I put notes to it to the right is how the EV is used in insurance.
Okay. EV
company.
is the same calculated for every company.
Oh, it is?
Yes.
Because I didn't. Okay, so there's not other. Because of the way the company's structured, there's not other either deficits.
No,
or benefits?
Just in the basic enterprise value calculation and total enterprise value calculation, no.
Oh, okay.
We'll get to some differences when we go to total enterprise value in terms of things like capitalized value of operating leases and stuff like that.
Okay. So I did see about 4. If you look at minority interest, there's about 4 companies with it. A couple of them were pretty small.
Yeah.
In there. Wasn't compared to the size of the company. Not much preferred stock except for Bank of America, which we're going to take.
You'll find that a lot in banks. You'll find banks for the most part are pretty much the only people that I've seen use preferred stock on a regular basis. I mean, there's companies here and there that will use it, but on a regular basis, banks will have preferred stock for the most part.
Okay. So in theory, that Constellation Brands, I forgot what that treasury stock number, that needs to be added. I forgot what that number was. Treasury stock which is a significant $2 billion, 2786.
And let me think about that before you add it, because
sure.
I like to go things when I don't come across them very often. I like to think about it from a logic perspective. Should we add this to enterprise value?
So if we bought enterprise value, I assume is when you buy the company, you're looking at the immediate obligations and the immediate benefits. So the immediate debt is an obligation and the immediate benefits. So is this is this an immediate obligation? I guess
I
is the
would
question.
say no after thinking about it. What would you say?
Treasury stock. So what is treasury stock? Treasury stock is stock that the company's holding. Yeah, I guess no, because it's not issued. There's no, if you're going to buy this company, then you're buying the treasury stock. Now it's up to you if you want to issue it or not.
Exactly. That's perfect explanation of why I wouldn't include it in the EV calculation.
Okay. Okay, great.
See,
So it's not.
making progress here. It probably seems like we're going slow, but I've found that the slower you go and the more you actually think about stuff, the faster you learn it because you don't have to go back over it as many times again.
It's interesting you say that. On the flight up and the flight back, I read most of a book called Make It Stick,
Okay.
which is a lot about learning. And they said one of the worst things of learning is rereading material. They mentioned deliberate practice, but they did mention a couple of interesting things. Is the best way to learn is the most non-intuitive when you don't think you're making progress. They say to read material, self-test yourself, try to recall the information, and basically do what we're doing, thinking it through. They say you won't feel as like you're making much progress, but they say long-term studies say that is actually the best way to learn.
And personally, that's what I found works best for me and other people as well. Like I said, it seemed, especially in the beginning while we're getting the foundations down, it will seem like we're going really slow, but the
That's okay.
concepts will hopefully stick in. If I'm doing a good job, the concepts will hopefully stick in your mind a lot better than if we were just going through this, saying the definitions, and then moving on.
Agreed. I definitely like when I was researching a program, and after you gave me the reading material, I mean, I think we're very much on the same page
Awesome.
in terms of how to learn. So
Perfect.
I'm excited.
Perfect. So let's go back to your notes again. Is there anything else here that you?
No, I think the treasury stock and the common stock were my only question. The market cap was one of the questions about the outstanding. So always, and it took me a while initially, the weighted average diluted shares. So that's just, so share prices fluctuate over a quarter.
Yes, and share.
And that's why they use weighted average.
Over a quarter, depending on options and share issuances and buybacks as well too.
So you get that from the income statement. So I'm assuming those values are correct.
Yes, this is the average. I believe how Morningstar and other sites and other sources calculate it is it's the average share count during any given quarter.
Okay, so as it fluctuates and as people buy and sell and as options are exercised, they average all that out, and then they include the diluted portion of it,
Yes.
and that's the number.
Yes.
And that's the most conservative number from our perspective.
Yes, the diluted shares, yes, because those shares, even though they're not issued now, they could be issued sometime in the future, which, again, I've seen a company where another company I own stock in had, I believe it was 12 or 13 million shares outstanding, but because they had a recent IPO and they issued a lot of options, they had up to 98 million shares that could have been issued.
Oh, wow.
Which, of course, I mean, that could have affected the company's valuation by multiples.
Of course.
If you didn't account that and you didn't have that in your valuation.
What's a seven times different from the outstanding shares, roughly?
Yeah.
Or 8, 7. Wow. Okay. So yeah, I think I'm okay. I guess the big question is, did I calculate the EV correctly based on
I'm gonna go through it right
based on the balance sheet and the income statement?
I'm gonna go through it right now on my phone.
Okay.
And that's a mistake I just made on my calculator that I still make to this day when I'm trying to go through stuff fast that you need to worry about as well. Is since this is in millions, I calculated as 42.6 million. That when I went to short-term debt, I tried to put it in there as 911. So you have to be, when you're calculating on the calculator, you have to be cognizant of that as well.
Agreed. I'm really, I'm very used to doing these Excel spreadsheets and this. And in the past, I was fooled by precision. Let's see. So even though I put this up here just for the homework assignment and to run through stuff and help me learn, but I need to be real cognizant of, since this is in a nice perfect row and they're perfect letters, that the bias is saying, hey, this is correct.
Yeah, no,
I guess I probably didn't explain that correctly, but hopefully you know where
that
I'm
makes
coming
sense,
from.
and it takes some time. Like I said, I've been doing this for 11 years, and I still made that mistake right now. That going through on the calculator on my calculator, just seeing the numbers on the screen and then putting in the calculator, you have to make sure you are on the right decimal place on the calculator when compared to what it actually is on the balance sheet and what you're seeing as well. So,
Sure.
and
I do have a quick question. Sorry to interrupt you again. Is does it really? I'm assuming for the market cap and if you notice the share price and the market cap, I use yesterday's date.
yes,
But everything else, I use the latest quarter.
yes.
I'm assuming that's not going to matter that much for the initial calculations that were the time frame is different.
No, that's fine. I mean, as long as it's within the most recent quarter, generally that's fine, because share prices change every day. Sometimes drastically. In my arena of small caps, stock can go up or down 10 to 25% in a day,
Okay.
depending on the volume. So it just depends on the particular day you're looking at. Obviously, if you want to buy under a certain price, you'll want to have some kind of alert set up that, oh, this reached my buy price, I want to buy now, and if it goes above that, I don't want to buy. So that is more where that comes into play. But when you're doing your evaluations, yeah, I mean, you'd literally have to change your evaluations every single day to match the different share price, and that would just, I mean, you would do nothing else but change your evaluations on that every day.
So this would be the correct methodology with the caveat saying the closer I am. So, for example, September was the last quarter. The closer I am to September, the more accurate the results. The closer I am to the end of the quarter on the other side. So as we go like next month, even though the share price of the market cap is going to change, I still use these September numbers. And I just got to be cognizant of where I am, and I guess cognizant of where I am in the quarter.
Yes.
For the accuracy.
Honestly, if you're looking to buy something,
Mm-hmm.
I once I do the valuations of the company and find out a buy price that I'm comfortable buying underneath, that doesn't change until the new quarterly numbers come out. The share price fluctuates every day, but my evaluation of what I think the company is worth only changes at most once a quarter, and usually I only reevaluate a company once a year in terms of
Okay.
what I look to buy underneath, or what I look for my margin of safety or my valuations.
Well, that makes sense from my understanding of what you do, which is really, really deep value investing.
Oh, yeah.
I mean, and when you do that, you're comfortable enough where you don't have to check price or look at every quarter.
Yeah, and like we talked about, I think on our initial call before you even bought the coaching program, was I will go days or weeks, months without looking at companies I own share price. I don't want to be impacted on a daily basis on what they're doing. Of course, I have Google alerts set up for any major news that comes across on the companies I own or that I want to own. So I know what's going on with the company and I see what's going on. But in terms of share price, I don't look at share price. If you ask me what the share price is today of the companies I own stock in for the portfolios I manage, I couldn't tell you. I could give you a guess and give you a close range, but I couldn't tell you within probably 5 to 10% of what it was.
Well, every time you check out, imagine you engage your emotional part of your psychology.
Yeah,
so
that's why I purposely don't check the stock price. I purposely don't check. I used to all the time, especially after I bought something. I'd check it constantly throughout the day, and I had to train myself not to do that, because that when you do that, you're not only do you engage your emotions, but you get into a short-term mindset.
you second guess yourself.
I'm in a long-term mindset, and even for me, an ultra long-term mindset. I'm thinking not months down the road, unless it's some kind of spin-off or special situation. I'm thinking 5, 10 years down the road. So
like Buffett, right? Forever.
yeah,
What's the best term? No to stock forever.
yeah,
No,
and
I'm agreeing.
I have a modified version of that. If I find something better and the company changes, then I'll make a decision then. But yeah, that general rule is correct. The best holding period to think of when you go before you even buy the company is you should think you're going to own this company forever. Are you comfortable doing that? Because that puts you in a perfect long-term mindset.
Understood.
And then here, you got the EV correct. Let's see if you got the EV to shares outstanding correct. And one thing, like I just talked about, this is in billions, this is in millions.
Actually, that should be millions, the EV,
this is
right?
in millions, but it's 51 billion.
Yes, okay, got it.
202 million as the diluted shares.
So the ratios should be correct. They're both in the same units.
That's what I got as well. So yeah, but that's another thing to worry about when you come to the share count divided by the share.
Got to make sure you're both in the same.
Yeah, and this is something else I wanted to talk about when we got here too.
Sure.
This, like we talked about the other day again, this is one metric to see.
Oh yeah, yeah. And that's
just be undervalued. And I can tell you right now that from Amazon, if you go to pretty much any investor in the world except for maybe Jeff Bezos, 99.9% of everybody else would say Amazon is overvalued. Again, this is just one metric, and his comeback to that would be, well, we're growing, we're constantly growing, we're going to grow into our valuation. As value investors, you can't think like that. Because, again, if you feel something and you think something is going to happen or could happen, that brings emotion into play.
It's a good point here. I'll probably change the nomenclature because I think maybe one of the pitfalls is that if I state it like that, it could anchor my thought a little bit. So I should say could be, or just put a caveat in there. Could be undervalued, could be overvalued, instead of just saying undervalued or overvalued, because I think that would be a form of anchoring that will go against a non-emotional judgment.
And that is a fantastic point you just came up with too. Is because most people, when they see something like that, when they see undervalued versus could be undervalued, it's only two words and it's only a minor difference in real meaning. But you brought up a perfect point there with anchoring bias. When you say undervalued and you leave it at that, you could become anchored, say, oh, this is my buy under price, or it's undervalued now because it's underneath this price. I'll give you a perfect real life example of where I became anchored by something like that. When I first bought my first truck, when I still lived in South Dakota, I think it was 2007 time frame, I bought my first truck, and gas at that time was in the $4.50 range. And to fill up my truck, it used to cost $80 to $100 to fill up the tank. And then when it dropped to here, when we got here, at some point it was $1.99 to $2.10 per gallon of gas. And I was like, holy crap, this is awesome. I'm able to fill up my truck for $40. And then when it went up to $2.50 or $3 per gallon, I was like, man, this sucks. I got so anchored on the price of around $40 to $50 per gallon that even though it was still lower than the $4 or $4.50 I was used to paying several years ago, I got so anchored to that price that when it went up to $2.50 or $3 per gallon, that I was frustrated. And I was like, this is stupid, Jason. You're anchoring to a price that isn't even most likely realistic at $1.99 to $2.10 a share, or $2.10 a gallon. But that's how powerful the anchoring bias is. So I'm glad you brought that point up.
Yeah, I'll change to something like maybe undervalued or maybe overvalued, just to hopefully counteract that bias in a little bit. I'm trying to think if I have anything else on here that that has that type of bias in it. It's already a nice, tidy figures and rows, so you automatically assume if it's tidy, right? If I look at a Excel spreadsheet and everything's tidy, that you associate a form of correctness to it. So I like what you said. I do a lot of when we initially talked, you said I do a lot of my calculations on paper. That also is something that I liked. I didn't want to see a lot of spreadsheets. So I just did this because it helps me in the homework.
No,
I don't know if I
that's
do
fine.
this.
Whatever works best for you. What I found works best for me and keeps as much emotion and bias out of it for me is, I can tell you right now, is I'll stop sharing this real quick.
Yep.
Yeah. Notepad and notes. I have
Same with me.
I have probably 10 of these with various different notes, calculations, even when I was earlier this year when I was going over apartment buildings. I do all the calculations on here, not only because it's what I'm used to doing and I think it keeps as much bias and emotion out of everything as possible, but when I was at the investment newsletter, they actually taught that if you physically write stuff down, you remember it better. Instead of typing it, if you write it down by hand, because you can't go as fast when you're typing, you actually have to think about what you're writing. It helps your memory better as well.
I didn't know that.
Yeah, I learned that when I was at the investment newsletter, and it makes sense. And now that I write literally everything down on a legal notepad, and I seem to remember stuff better. And I've been getting remarks from my wife and some people, some colleagues that are like, "How do you remember that stuff?" And I was like, "I don't know." So it obviously helps.
That's some real good points. I just need a so I got the figures right in the Constellation Brands analysis.
Yes.
So just something I noticed in the company above, the weed, and I'm curious if I've made a. I'm curious if my observations are correct. Does that seem to me that it has low debt and a lot of cash in that aspect, based on the market cap?
And that's a great point to bring up, because on an initial preliminary analysis, which we'll get to hopefully next week or the week after, we'll do a whole preliminary analysis of the company. Another reason I calculate enterprise value, and I'm to the point now where I can calculate it without looking at the definition or anything. I just automatically bring up the worksheet or bring up the company on Morningstar and get to calculating EV. One of the reasons I do that is to look at the company's cash levels compared to its debt levels. Of course,
it just struck me based with all the other companies. It strikes me as a really attractive balance. Is that?
Yeah, no. I mean, obviously, pretty much 100% of the time, unless it's a big company that can support debt, you want as little as debt as possible compared to their cash levels. Cash,
Is that a good ratio? That's in your experience?
Yeah. Cash. The reason that is cash gives you options. It's an opportunity cost, or as what Warren Buffett puts it, it's dry powder. With cash, you have potential to do things. You have potential to put money into research and development. You have potential to pay dividends to shareholders. You have potential to acquire another company. If you have very little or no cash compared to debt, you're in trouble, because debt is an automatic payment. Even if, let's say, this company let's get rid of the long-term debt here. If the company just had $2 million of debt and no cash, and it didn't have any cash flow, theoretically, even though it's a $3.7 billion company, if they couldn't pay their debt because they weren't producing enough cash flow and they didn't have any cash, they could be bankrupt. A $3.7 billion company could go bankrupt off a $2 million payment.
Sure, because you have to make the payment. And then they'll start going after the assets, I assume, when you don't make the payment.
Yes. So, go ahead.
Oh, that's it. No, that's it. That's just an observation that I looked at. That looked like a great ratio compared to all the other folks. And I do remember reading Buffett. I do remember reading Buffett where he said, look for companies with really low debt and a lot of cash.
Yeah, and it still works. I mean, occasionally you don't. And I just wrote this yesterday. I'm working on some valuation templates all the valuations I do on a regular basis and all the metrics I calculate on a regular basis. I'm putting that in a template, not only for you, but for other students and other coaching program clients. So once we get to that point, I'm going to send you that 20-page document. But
Great.
one of the things I was doing in there yesterday is the cash, like you said, the cash compared to debt. It's ultra important, especially for deep value investors like us, because cash gives you a margin of safety, like I just talked about. You can still find companies selling below the Benjamin Graham valuation, the NCAV valuation, the net. And that's actually one of the first valuations I do on every company because it's easy to calculate just from the balance sheet numbers on Morningstar. And that's, again, that's that, and the NCAV valuation is net current assets, or current assets minus total liabilities, which gives you the quote net current asset value of the company. Generally, that's cash and net current assets. Yeah, it's pretty much just cash for the most part. But you can occasionally, I actually own stock in, I don't know if they still are selling below that valuation, but there are two companies I own that the main reason I bought them because they had more risk than I would have been comfortable with in a normal company, but they were selling so far below their net cash value that I bought them, and now they're up. I think one's up 3 times and one's up 2.5 times since I bought them. That, again, that's the power of cash as well.
Gives you options, like you said.
Yeah.
So okay, so my initial thoughts on it were correct. The ratio is pretty favorable.
Yes.
Great.
And actually,
okay.
This looks low to me right here. Apple only has $20 billion in cash. Oh, never mind. They've been buying back a lot of stock.
Oh, they have?
Issuing dividends.
I guess we could check it on the Morningstar.
No, that's fine. I was just going through the numbers real quick after you mentioned it, and comparing it to their size and their debt levels. And this is another problem I have with banks right here.
Yeah, well, like the derivative on their sheets, I'm like, I don't really want any part of that.
Yeah, and we can get to that on another day. But yeah, I like to think of them. I don't remember who said it. It might have been Buffett, which is funny because he now owns Wells Fargo. But it might have been Buffett in one of his early partnership letters or early shareholders letters, or their banks can be investment black holes because there's so much off the balance sheet that they just put in derivatives or other assets categories that even if you go into the footnotes, they do a terrible job of explaining exactly what they are. So they just,
and number manipulation, sure.
They just scare the death out of me, honestly, banks, because there's so much unknown. And as an outside shareholder, there's already only so much information that we as outside shareholders can have. So the more I can know about a company, the better. And that's another reason I stay away from banks, is because even insiders, I mean, I don't know if you've read some of these books about Goldman Sachs and stuff during the financial crisis. These people that were doing the derivatives and stuff like that, there was probably only, in most cases, there was only one or a handful of people in the entire company that knew on a deep level what these kind of derivatives and CDOs and kinds of things could do to a company, and they brought the entire world financial system down.
Well, I'm glad we're on the same page with that. I just put it on there just to get diversity, but I would I'm not that interested in investing in it. So as we said, I'll take gold, Chevron, and B of A off, and I'll come up with 3 new.
Perfect. And do you want to touch on total enterprise value at all today, or do you want to leave it here?
If we could just touch on it, we don't have to get too deep into it. That's perfect. I think I have my arms fairly around enterprise value and kind of the meaning behind it.
I'll bring up that template I was telling you about that I have. I'm having my team finalize and make sure there's no spelling errors right now.
Okay. So I have your document here too with the total enterprise value. Before we get into that, can we look at it more holistically? I looked the definition up online, and I'm not sure if it is correct or not. That looks at it more. This gives you the calculation, but this definition maybe is more holistic, and I wanted to see if you think it's correct.
Yeah, go ahead with the definition.
Actually, can I share my screen?
Yeah, I'll stop sharing on my end.
Okay. Now, how do I?
The plus button down at the bottom on your main Skype screen.
Oh, there we go.
Click that, and then you can share screen from there.
There we go. Share screens. Okay. So let's share the screen and then start. Okay. Can you see that the LinkedIn enterprise value is different from total enterprise value?
Yeah, I would agree with this the top definition on a basic level. Yes.
Okay, so enterprise value is the value of operating assets. Total enterprise value, you have operating and non-operating assets.
Yes, and so what does that mean? What is the difference?
Yeah, what is the difference?
I'm going to go back to my screen now.
All right, let me stop sharing. There we go.
Okay, so what does that mean, and what is the difference? The difference here, enterprise value includes market cap, short and long-term debt, and cash equivalents.
Okay.
So, enterprise value is basically the value I would look at. It's one of the values I would look at if I were to buy the entire company. Total enterprise value is the closest thing to the true value of the entire company, including all of its important assets and all of its important liabilities. Why is that important? Because if you acquire a company, or you're looking to acquire a company, and they have a lot of operating leases and unfunded pensions, you would want to know that, because that cost will become yours if you were to acquire the entire company. And
so it's all the obligations, not only the short term. I guess, would it be considered short? I guess it could be both short or long term obligations.
Operating leases and unfunded pensions are long term liabilities in most cases. A lot of companies don't treat them as long-term liabilities, and this is why operating leases right here, you see this most of the time multiplied by 7. When I first learned total enterprise value, I asked why it was 7, and the person who taught me it just said, because that's what they found it worked.
Okay.
Yeah, so they didn't really give a very good definition, but I was just grateful that they shared this important knowledge with me at that point. But after years of analyzing companies and going over thousands of companies, the number 7 makes sense, because most of the time these operating leases are for things like buildings or major equipment that you're going to use over 5 to 10 years. So the average of that is about 7.5. So you round that down to 7. That's what I found works. There is an example down here. This company right here there's the operating leases right there. And then they also had other equipment that they were leasing on a long-term basis that I had to capitalize as well. And you'll see here, I multiplied that number by 5 because the contract was for 5 years.
Okay.
This number right here is the operating leases, which you capitalize by 7.
So that number listed on the balance sheet, if it's an annual balance sheet, is just for the year.
Yes, and I can actually.
That's why you multiply by the number of years.
Constellation Brands.
Yeah, I was going to say, can we just walk through maybe one example, and then I'll try it on my own?
Yeah, what I like to do here is I bring up their financial, and I tried to put this in a Word doc, but it was going outside of the Word. It was going outside the margins of the Word doc. So, what I do here is I search operating lease, and it's finding all of them. This is what it's usually in: commitments and contingencies in the footnotes. There's different terms, but generally they mean the same thing: commitments and contingencies. Okay, so I'll read this straight. Oop. Screen is lagging. I'll read this straight to you, and then I'll go to the numbers.
Okay.
The minimum lease payments for our operating leases are recognized on a straight line basis over the minimum lease term, which means they're capitalized. Let's say that $10 million over 5 years, they do $2 million each of the 5 years.
Okay. Got it. So it's a linear relationship.
So
Okay.
step rent provisions, escalation clauses, capital improvement funding, and other lease concessions, when present in our leases, are taken into account in computing the minimum lease period payments. So what the hell does that mean?
Yeah, exactly.
This means that all of these important things, and I'd have to read the full financials to know exactly what they're talking about here. But these, if you were, and the way I always like to think about it is, as a full business owner, what are the costs, the long-term costs I would have to be worried about if I were buying the whole company? This means these are longer-term costs that are important to know about, and they're considered to be operating leases.
Okay. So these are all the combined leases for all the buildings.
And they combine it into one general term called operating leases in their case.
Okay.
Okay, so let's scroll down now. And this is important as well. Future payments under non-cancelable operating leases. Non-cancelable is the key word there. So again, as a long-term business owner, if I were to buy the company, I would have to pay these leases no matter what my contract with the buyout says.
Okay. Having initial or remaining terms of 1 year or more as follows for each of the succeeding fiscal years. So it's basically saying that those payments have to be made each year,
Yes,
no matter what.
No matter what. And
so is that taken into account in the operating lease, those totals?
Yes.
Or is that additional?
No, these operating leases right here, this is the full number of operating leases that they talked about above. They just rolled it all into one number.
So that number down the bottom, if you scroll, that 200 million, if you scroll down there it is, or 497.
Yeah, this is the
so that 490, that should be in the financials, right?
In which financials?
Either, I don't know where they have it, the balance sheet or the income statement, or that 497.7.
Yes, they should be considered liabilities. Most of the time, these kind of things are considered other liabilities or other long-term liabilities, and then you have to go in the footnotes to figure out what that means.
Rental expenses.
So up here, you don't use that total number when you capitalize. I usually use the most or the closest number. So the 2018 numbers is what I would use to capitalize. So I'd put that. Are you calculating this? Do you want to calculate it real quick right now?
Yeah, I would like to calculate just one.
Yeah, go ahead.
So total is the market cap.
Yes.
So let me go back to my spreadsheet. So the market cap we had at 42.6 billion. So you're going to have it in the, so it's 600 million. Right. And then, so it's market cap, all debt equivalents, including capital value. So
in that calculation, you add short and long-term debt on the balance sheet.
Yep. And is all these numbers, is everything we're looking for here on the balance sheet typically?
No.
Okay.
You have to actually go into the financials to find operating leases and unfunded pensions.
So those are the only two things we add over and above enterprise value are the operating leases and unfunded pensions?
Yeah, in most cases, except for unless they have other long-term leases like this other company I just showed you on one of the companies I own had other long-term equipment leases that I added in there.
Okay, can we go into the Constellation then? Can we calculate it for Constellation?
Yeah, you have the market cap written down.
I do.
You have those
42. I don't. Let me write that down. So short-term debt for Constellation's 911 million. And then long-term debt is 8,037 billion. Okay, I have those written down.
Okay. So the other number is, and again, something I wanted to point out to you. These numbers are in millions.
Yep.
So
I got everything. I got everything in millions right now.
okay, perfect. So
Everything's
so
in
add
millions.
41.6 times 7. I put that in parentheses.
Oh, this is. I'm sorry. This is the. This is Constellation.
Yeah, the operating.
So I guess if this gives you the total operating leases, why wouldn't you just use that number for the actual number?
This number right here,
On the bottom one,
because
which says
these change over time. You'll see here that they're going down and then they go back up in 20 thereafter. They just kind of have a thereafter period. So I like to use the most recent or the most the closest number because these fluctuate over time. And that's just a personal preference thing on my end.
but don't we know based on this that the debt obligation today is 497 million?
Yes, but they could, if they wanted to. It says non-cancelable, but if they wanted to pay a fee, they could get out of these contracts and do another kind of operating lease.
Okay, that makes sense. So
And
okay, so
7 years is a long time. So
okay, I got you. Just like if I wanted to get out of my lease for rent, I could just probably pay an extra month or two, and most likely they'll let me go.
yeah, exactly. So
All right, so I get 291.2 based on that.
okay, and then what I would do next is I would go back up here, hit Control F to search for pensions.
So just so I know, I can't see the top. Did you just go to the quote page, put in Constellation, and then do a search?
No, you have to go. Here we go. I'll go back.
Yeah, if you could kind of just go how you got to that point.
From any page on the main page of whatever company this is, the quote page, financial page, or whatever, you go to the filings.
Ah, okay, filings.
And then to find unfunded pensions and operating leases, you have to get the annual report. Those numbers generally aren't listed in the quarterly reports.
Okay. I didn't know a lot of companies did pensions anymore. I would not think a lot of the small caps.
Oh yeah, 95% of companies I've ever evaluated over the years don't have pensions, but when they do, you want to know about it because, as you probably know, they can be huge costs.
Yeah, yeah, of course.
Okay, so here we go. So this page will come up when you go to the filings, and then you want the 10K or their annual report to find these numbers. Again, the unfunded pensions and things like operating leases will not be in the quarterly reports. I don't think ever.
Okay.
I don't think I've ever seen that.
So you just go filings, and then you go to annual.
Yep, and then when you click on this, that's when it brings up the other page that we were just on.
And then you just search the annual report itself. Okay. Great.
So this company does have some pensions. A lot of the times you have to kind of, especially when it comes to pensions, you have to figure out what the number is because they don't just outright list these are total pension liabilities. They put it in legal minutia and crap because they don't. This is a personal bias of mine. I think they do it because they don't want people to figure it out.
Sure, because it goes against the valuation.
That they have to list it a certain way, but I personally think they do it to make it harder for people to look at.
Sure, because it's a negative for them.
Yeah, exactly. Okay, so post-retirement adjustments, not the one we're looking for. Okay, this might be it. Okay, yeah, here we go. So here is adjustments. Yeah, see, and even here they don't have just a total liabilities or This is our net liability or asset.
Other compre, yeah, it's a negative number and balance.
Let's go. I've got it. I'll be right back.
Sure.
Sorry, my dog wanted outside and then he wanted back inside. Okay, so now we're back at the top. Here's the adjustments. There should be somewhere where it says balance, and it should be either positive or negative. Most of the time it's usually negative. But I am not seeing that here. So, like I said, they try to make it as confusing as possible.
Pension retirements. Right now, maybe down the bottom there, I thought I saw a balance. There's a balance negative 13.1.
Yeah. So, yeah, add that. 13.1. These are in millions as well.
Okay. I guess if you have if they list a lot of figures there, you're a little bit confused. You just use the largest figure for safety.
Yeah. Conservatism. Perfect. Okay, and then, got out of that, didn't want to. Okay, so the next thing I would do is I would search for just a general term, lease, to see if there are any other kind of equipment leases. And lease is going to bring up a ton.
So that was building leases. So we're looking for building and equipment leases.
Okay, none of that is it. Aha, this is something I would note to look at later, right here. They own or lease approximately 21,000 acres of land.
Vineyards, that makes sense. Wine's a big part of their industry.
So I would keep a note of that, and so we would know to count that in the evaluation later.
We continue to purchase these lease edition.
Oh, sorry.
No, it's okay. I was just wondering, they have to account for that somewhere,
yes.
Right?
Yes. We'll get to that at a later point.
Okay.
Okay, so I'm not seeing any other equipment leases here. So what's next on the list?
So next is cash equivalents. So that's all the additions, and then we minus cash and cash.
For this,
yep.
I want to go back to the balance sheet because, again, to get the most recent numbers. All these pages open, and not one of them is the balance sheet. Alrighty, so they have, as of the most recent financials, they have $126 million in cash and cash equivalents.
So you go under total cash then?
Well, they list out cash and cash equivalents here. They only list cash and cash equivalents on this company's financials.
What if another company had other stuff underneath that?
They would break it out, and they would say something like restricted cash or something like that.
And all we want to use is cash and cash equivalents. Yes. Okay. So that's 126 minus 126. And then minus short-term investments.
That is found usually on the balance sheet if they have any.
That should be under current assets, right?
Yes, and it doesn't look like they have any.
So that's 0. Short-term investments now minus long-term investments, which is under other, I'm assuming, long-term assets.
I would just subtract all of this for conservatism right here.
other long-term assets. All right, not just investments, but other assets. Okay. Well, it now, is that conservative? Because the higher the number, the more favorable, right? Because the denominator.
Yes. Yeah, I'm a very visual person, so I'm not doing it right now. So, yes.
That's okay.
Yeah, so we would actually, let's just, instead of taking the shortcut, let's go and see if they have any in the financials. Short-term investments.
Okay.
This is what I would really do. I don't take any shortcuts.
Okay.
I do my own, so let's just do it for real right now.
Sure. Okay.
Short-term investments, yeah, they list none. So I would leave that.
Long-term. Which we said they didn't have any short-term investments. So now do we want to look up long-term investments?
I'm going to go to the balance sheet, actually. That's usually the fastest way to find.
Oh, the actual, in the report.
Yeah.
Okay.
And I want to actually get to the actual balance sheet, not just where they're talking about the balance sheet.
Got it.
Oh, here we go. So, no short-term investments and no long-term investments either. They would list that out.
Okay, so I can say 0 then. That would be conservative, right?
Yeah. And here, actually, now this would lead me to, it says other assets. I would go search other assets to see what it says those other assets are.
Okay.
Foreign currency contracts. Those don't add those.
No.
Derivatives, don't add those. Interest rate swaps. Yeah, don't add any of those.
Okay, so
short and long-term investments generally are either like they own stock or bonds, or they own investments in other companies.
Stock, bonds.
Yeah, you don't want to add any of this kind of stuff in there.
Well, that's good. That was a good lesson. So if you have a number and it's conservative, great. If you have a number and it goes against you, dig into it more.
Yeah. All right.
Got it. Okay, so 0 for short term, 0 for long term, and then net deferred tax assets.
One of my favorite things in the world, because
That's
hardly anybody will look for these.
what the heck is that? Net deferred tax assets. Can you give me some examples of those?
Yes. Net deferred tax assets can be things like net operating loss carry forwards, tax credits, or tax credits, usually is what they are.
So you get tax credits on any losses pretty much, right?
Yes. They can also be things like Berkshire Hathaway is a perfect example. They've owned See's Candy for forever.
Yes, it's 72.
Yeah, they bought it for $25 million. If they were to buy it now, and it's produced over $1 billion in operating profits since they bought it. So if they were to sell it, they would have a massive deferred tax asset on there that they would have to pay taxes on. It can also be things like that as well. But those are generally for bigger companies that have longer term. And if you don't find net deferred tax asset, you can just find it deferred tax. There we go. See deferred taxes. Let's go down.
Oh, net deferred tax asset is obviously.
There we go. Deferred tax provision. These are the things you would have to pay taxes on if you sold them, or their tax credits, or their net operating loss carry forwards.
So it's not a benefit. Yeah, if he sold that business,
it's not a benefit. It is a benefit while they hold these assets, if they actually in fact do hold assets.
It's like us holding a stock. We don't have to pay taxes on it until we sell.
And I'll send you some information about investment float, which goes a lot in depth on deferred tax assets and how they can be so valuable as well. It's a part of investment float.
Okay, understood. So deferred tax provision. So we'd use that number?
I'm gonna go down. They usually explain it better in another section.
That's
Here we go, right here.
okay.
So I would add into that calculation the loss carry forwards.
What does that mean? Lost carry forwards?
Net operating loss carry forwards. They were unprofitable, and you in the U.S. if you're unprofitable, you can get a tax loss carry forward that you can carry forward to pay against future profits.
Okay, so that's a benefit to us then.
I would add
Okay.
that in there. I wouldn't add stock based compensation because you never know if or when that's going to be used. Inventory, I don't even know what that deferred tax.
That's a tax credit on.
Yeah, I would assume that's some kind of tax credit for green technology or something. I wouldn't add that in
Okay.
there.
Yep. You would add it, correct?
No.
Would not. Okay.
Not. Yeah, the only thing from here I would add, actually, I would just add this whole number right here. This deferred tax, the net number.
So I say the higher that number, the more conservative the calculations.
Yeah, and you always want to add the net number because as you see down here, they have liabilities, deferred tax liabilities.
Okay, deferred tax asset. Got it. Okay.
The screen isn't scrolling down for some reason. There we go.
Okay. So I think that should do it, right?
Yep.
All right. So the number I have.
Actually, I should have told you to wait because you see these deferred tax liabilities net here are 1.1 billion.
Mm-hmm.
Their deferred tax assets net are only 101 or 102 million. So they have actually, when you consider the liabilities, they have a net negative deferred tax liability of like $900 million. So I would leave that deferred tax asset as zero because essentially they have negative assets in.
I see what you're saying. So you have to take the deferred tax assets and the liabilities, add them up.
Yeah.
So they don't have any deferred. It's actually they have more deferred tax liabilities.
Yeah, so I would leave that number as zero.
So, all right.
Perfect.
So I'll verbally walk through. So market capitalization is 42,600 million, plus short-term debt of 911 million, plus long-term debt is 8037 million, plus what was the next one? Capital value of operating leases of 291.2 million, and then the other one is unfunded pensions of 13.1 million. And now the only thing we subtract is 126 million of cash and cash equivalents.
Yes. Perfect. And what do you get when you add all that up?
I have 51 billion, 726 million, 726 million, 300,000.
Okay, and now I'm going to go back to your sheet and compare that to enterprise value.
Yes, it's roughly the same.
Okay.
Because that's 51,439. I have 51,726.
Okay. What does that mean to you, if anything?
Well, that the other items we're adding to get to the total enterprise value aren't affecting the valuation that much.
Okay. Yes, this company doesn't have a lot of unfunded pensions and operating leases and deferred tax assets.
So that's a very small percentage in the calculation.
If this was a company, for example, that had a lot of unfunded pensions and deferred tax assets and operating leases, the TEV number in a lot of cases can be wildly different from the enterprise valuation. In this case, they're pretty much similar, which means as a potential owner of the entire company that these long-term liabilities don't and assets, long-term assets and liabilities don't make that huge of a difference on the overall valuation of the company.
Understood. And that could be, theoretically, that could be even lower, which would be even better because you would have long-term investments in net deferred tax assets.
Yes.
So if the total of that, if the TEV is lower than the EV, it's a good thing.
Yes. If the TEV is lower than the EV, that means the company has either a lot of cash compared to their debt and their operating leases and pensions, or they have a
Mm-hmm.
lot of deferred tax assets, NOLs and tax credits and things like that, that could add to the value of the company. In this case, they lower the enterprise value of the company, but they would increase the value of the company in terms of what we're looking at as deep value investors. Because, like I said, 95 to 99% of people will never even do this calculation at all, and they won't know what the operating leases are or the deferred tax assets are.
And when we look at small, especially when we look at smaller cap stocks, people don't go that deep. Most individual retail investors like you and I are not going to take that. That's why you said if you find a company that has a high net deferred tax assets, that's a little bit more gold.
Yeah, I mean, it's not rare to find companies with negative enterprise values in the small cap arena. And what to you, what does that mean if they have a negative enterprise value?
Negative enterprise value. Let me just look at the equation here. Hold on, enterprise value. So, well, there's two possibilities. Either the numerator is negative or the denominator is negative. So if the numerator is negative, then that would be a bad thing. If the denominator is negative, that would be a good thing, I would imagine.
Getting too complex. You're sort of right, but you're too complex.
Okay.
The way I like to think about negative enterprise value is the company has more cash. Let's just stick with enterprise value. If the company has more cash, then the company has debt, and the company's market value is worse, which means that the company could be massively undervalued.
Well, what would be? I guess how would you get a negative? I'm thinking how would you get a negative enterprise?
Right now, let's say the company's market cap is 100.
Okay.
Let's say they have cash of 140.
Okay.
And they have debt of 20.
Okay. So it's 100 plus 20 is 120 over 140, right?
No, 120 minus or 140 minus 120.
Oh, I'm sorry. I get the wrong calculation. Okay. For some reason, I was saying it was a fraction. Yeah, 100 plus 20. 100 plus 20 minus 140.
So they'd have an enterprise value of negative 20 million.
Negative 20 million. So I was thinking of the other stuff wrong. I was putting denominator and I was thinking of the other stuff wrong.
Yeah, no, it'll take time. It'll take time to get used to all of this. No worries. It will. I can guarantee you, with what we're doing and the deliberate practice we've talked about, you will be frustrated a lot, especially this foundational stuff, because it does take some time to get used to. But once you get it, and you can it's an automatic switch in your mind. It just goes off and automatically think, oh, negative enterprise value means is one sign the company could be massively undervalued. It will once we build this solid foundation, it'll speed up the processes and valuations and evaluations later.
That's what the book Make It Stick said. He said, just try. You'll learn something better if you try it. If you try to come up with the answer, even if you don't get it right and you get some corrective feedback, they said that's the best way to learn.
Exactly.
Don't just read and think you have it. Just go through the examples. Try to recall from memory. Don't look at it says don't look at the answer right away too. If you do a problem and you get don't train your mind to go look at the answer, because then it won't try as hard to retrieve the correct answer.
Exactly. And the way I think, or the way I do it, is I get frustrated still on a daily basis every single day because I'm pushing myself to always learn more. does it suck in the short term to be frustrated on a constant basis, and does it sometimes lead to bad days or bad moods? Yes, but it speeds up the long-term process of learning, and the more frustrated I'm listening to talent is overrated still, and the way they put it is things that are just out of your reach that are going to frustrate you and confuse you. The faster, or if you're learning things that are just out of your reach, you'll learn infinitely faster than if you're learning in your comfort zone, or you're learning things that are way too hard and things it's looking at Chinese to you.
You said that in one of the documents, one of the articles that you sent me. Um, I think it was not a lesson. Maybe it was the deep work, or was how to become an expert at anything.
Yeah.
And it did say, you want to be in that zone where it's just over the reach. If it's too easy, you're too comfortable. If it's too hard, then it's not going to be good learning. So great.
Yeah,
so I know it's getting.
Let me know. And I tell this to everybody I talk to, is because I can deal with a lot of frustration because I've been in this mindset for a long time. If you're getting so frustrated where you're wanting to give up, or you're just not wanting to do anything for the day, let me know. That means I'm pushing too fast. So you're going to kind of have to let me know what your level of comfort is there as well, because I don't want to push too fast and then you skip over some stuff you should be knowing, and I should be explaining better as well.
No, not at all. I'm pretty obsessed with learning this stuff. Hence, getting up at 6 in the morning and doing this before my work and doing. I'm pretty obsessed, and I'll let you know. But for the time being, I'm really I'm excited. I'm motivated. I wouldn't even say motivated. I'm more obsessed with learning this. So I think the pays, like this session, the last session, were fantastic. What should I use, or what would be my homework? And before you answer that, maybe would it be possible? Could we spend maybe an hour tomorrow? Would that fit in your schedule?
What time are you thinking? Because I'm going to be busy in the morning, my time.
Perfect.
Probably in the morning. Probably in the morning. In the afternoon, my time, I'll be busy.
Okay. Well, just the only commitment I have tomorrow is 7:30, 8:30, 9:30, 10:30 your time till about 12 p.m. your time is the only commitment I have.
Okay, perfect. So if we were to do it like afternoon my time, that would work?
Yeah. Just give me a time if you want, and I'll make myself available. Oh, they are.
Instead of doing Veterans Day off on Monday, they're doing it off on Friday now here. So.
Okay. Well, let me ask you this. I know I don't want to make it a habit or anything, but would Saturday be a better day for you if you want to take the whole day with your daughters, or do you have weekend plans and stuff like that?
My daughter's celebrating my oldest daughter's birthday this weekend, so tomorrow would be better.
Friday would be better. Okay. Well, I'll definitely be cognizant of your time tomorrow, if you don't mind. And what should be my homework? What should be my homework assignment for tomorrow?
Then calculate TEV. Go over these steps that we just did. Calculate TEV for, let's see.
Which companies?
Let's try 3 companies. Because that'll probably push you enough to where you'll learn enough, but you won't be super frustrated about and just doing it over and over again, and then it becomes rote at that point and you're not learning anything.
Oh, plus if I do it wrong too, I don't want to keep repeating the same mistake. Okay. And then I'll pick 3 new companies also. So which 3 companies should I do it for?
Let's go Apple, Illinois Toolworks, and Amazon. Those should be relatively straightforward.
Okay. Excellent. All right. Very good. Let me get going. So my schedule today is I got to get some stuff done this morning. I'm going to go work out with my wife. So about 2 or 3 o'clock, I'll start working on this. So hopefully I have it to you by 7 to give you a little bit more time.
Okay, perfect. And I will, I'll get with my wife and see what the specific plans are for tomorrow, and then I'll send you what time we can schedule for tomorrow.
Yeah, I'll work around your schedule. As long as it's not that time, I'll make time whatever time you want.
All right, perfect.
Excellent. All right, Jason. Great session. I appreciate it.
Thanks. Have a good rest of the day.
Thanks. You too. See you tomorrow.